In the last 48 hours of trading, something happened in the gold market that is not supposed to happen in a market this old, this global, and this liquid. $467 trillion. Trillion, 4,000 previously. They said this kind of split could never become visible again. They said modern clearing and reporting would prevent it. Yet the data is not whispering right now, it is speaking plainly. Institutions see it first because they live inside the plumbing, inside the margin calls, inside the settlement desks, inside the vault reports. Everyone else sees it later when the price chart starts to look like a story you can't unsee, and the headlines begin to retrofit explanations that sound tidy but miss the mechanics. Here's the pattern interrupt. The gold price most people track is often a price of leverage, not a price of immediacy. It reflects how aggressively traders are buying and selling futures contracts, how quickly positions are being reduced, and how much risk a balance sheet is willing to carry today. Meanwhile, the price of actual bars, especially in physical hubs where delivery is the whole point, can behave very differently. When those two prices begin to argue, the argument shows up as a premium, a discount, a forward point, a widening exchange for physical spread, and a subtle tightening that only becomes obvious after the crowd is already looking in the wrong direction. Welcome to Channel Name, where we decode what matters before it becomes tomorrow's talking point. If you like having the market's plumbing explained without hype and without noise, you're in the right place. Consider subscribing the way you'd keep the number of a wise elder who always seems to know what's coming before it arrives. And tell me in the comments where you're watching from, because this market looks different depending on whether you're standing in New York, London, Zurich, Dubai, or Shanghai. Now let's reconstruct what actually happened, with dates, numbers, and the kind of detail that makes the story hard to wave away. A 180 RMB per gram. Even if you never convert that into dollars, the message is clear. Physical hubs don't print extremes without a reason. They print extremes when demand meets constraints, when financing terms shift, when local liquidity tightens, or when the marginal buyer is willing to pay up for metal that settles, not metal that merely represents exposure. Then, in the first week of February, the paper side shifted in a way that can look like a separate story until you lay the dates side by side. 4,000 previously. That's not a gentle drift. That's a meaningful chunk of leveraged exposure, stepping back in one reporting window. Moves like that happen when volatility changes, when risk models tighten, when funding costs rise, or when a trade that felt comfortable suddenly becomes expensive to hold. At the same time, the bridge between paper and physical kept turning. 90. Those numbers matter because they sit at the seam where claims can become metal. Most futures participants never intend to take delivery, but the delivery mechanism is the pressure gauge. When it stays active during a dislocation, it tells you that someone, somewhere, is still treating settlement as a real option, not a theoretical footnote. So here's the central contradiction. How can a market show enormous vaulted stock in London, show a sharp reduction in paper positioning, and still show signs of physical tightness in the places where real metal changes hands? This is where many takes become slogans. They blame speculators. They blame one scary headline, or they imply a villain without understanding the structure. You don't need drama to explain a dislocation. You need to understand that gold is not one product. A futures contract is a standardized promise whose economic life is driven by margin, liquidity, netting, and risk limits. A physical bar is an object with a location, a brand, an assay, and a settlement pathway. A bar in London is not the same thing as a bar settling in another hub on another timetable with another set of rules, even if the headline price tries to pretend all gold is instantly interchangeable. To see why this matters, step back and look at the hidden pattern across decades, because gold has done versions of this before, and the playbook repeats with different costumes. In 2008, the global financial crisis forced liquidations across portfolios. Funds sold what they could, not what they wanted. Paper prices were pressured as leverage unwound. Yet physical demand for coins and small bars surged, and dealers in many places saw shortages and delays. Premiums rose, even as the headline spot price dipped because the supply chain could not instantly expand. The lesson was brutal and simple. Price can fall while availability tightens. The chart can say one thing, the checkout line can say another. In 2013, the paper price fell hard in a dramatic sell-off that changed the narrative overnight. But physical demand, especially in Asia, surged as buyers treated the paper decline as a window to secure real metal. The result was a geographic flow. Metal moved from west to east. The headline price reflected paper pressure. The long-term redistribution reflected physical appetite. The playbook was the same. Paper sells first, physical absorbs later, and the spread becomes the message that tells you which side is actually setting the next chapter. In 2020, the pandemic shock created a different kind of dislocation. It wasn't only about demand, it was about logistics. Flights were grounded. Refinery throughput faced constraints. The usual pathways that move bars between hubs were disrupted. Spreads widened because the world discovered again that moving metal is not the same as moving a number on a screen. The paper price can update every second. A bar can't teleport. The market responded by repricing immediacy, not because gold changed, but because the pipes did. Now in 2026, the pattern is rhyming again, but with two twists that make it more important to watch closely. First, the official sector bid remains historically significant. Second, the market is more fragmented than people realize, with multiple reference prices and multiple settlement cultures operating at the same time. Let's talk about the players, because the dislocation stops being mysterious when you understand who is moving and why. Start with the vault system. London is a nerve center for wholesale gold custody and clearing. When London reports 9,158 tons in vaults at the end of January 2026, it is telling you there is a vast pool of metal underlying a large portion of global trading and collateral. But a large pool can still be tight at the margin. A warehouse can look full, while the inventory that is actually available for new claims is limited because much of it is allocated to specific owners, pledged as collateral, or held by entities that do not respond to short-term price swings. The headline number describes existence, not willingness to mobilize. Then consider the paper engine, futures exchanges, clearinghouses, prime brokers, and the risk desks above them. On the paper side, gold is a balance sheet game. If volatility rises, margin requirements can increase. If funding conditions tighten, leverage gets expensive. If a risk model says reduce, positions are cut. If a fund needs cash, it sells what is liquid, and gold futures are liquid. That is how you get waves of selling that have little to do with whether anyone suddenly decided gold has no value. It is often about how much risk can be carried cheaply today, and how quickly that answer changes when conditions shift. Now add the official sector. 3 tons. That is not a rounding error. That is a strategic bid. Central banks do not trade like a day trader. They buy to diversify reserves, to manage currency risk, and to hold something that is no one else's liability. When that bid exists in the background, physical tightness can stay firm even when paper markets are noisy, because a meaningful share of demand is not price sensitive in the way leveraged flows are. Now add the physical hubs and their local price signals. Shanghai is not a sideshow. It is a venue where delivery and settlement are central, where local conditions can express themselves through premiums, and where demand can remain firm even when paper markets are volatile. 180 RMB per gram, it is a flare. It tells you the marginal buyer is willing to pay up in that context, for that form of metal, under that settlement structure. And finally, add the intermediary layer that most people ignore. Refiners, fabricators, logistics networks, and the arbitrage desks that try to keep the global system aligned. They are the ones who melt, recast, assay, and ship. They are the ones who know the difference between a large wholesale bar sitting in London and the smaller bar sizes demanded elsewhere. They are the ones who calculate whether a spread is wide enough to justify freight, insurance, refining fees, and time. When spreads are narrow, metal stays put because friction isn't worth it. When spreads are wide, metal moves because the incentive finally beats the friction. So what happens when these players move at the same time, but in different directions? You get the dislocation we're watching now, 6,000 in net speculative positioning. On the other side, physical indicators show persistence. London's vaulted stock remains massive. Shanghai prints extremes, and the delivery machine continues to process large month-to-date volumes like the roughly 33,783 deliveries recorded by early February. Two markets are telling opposite stories. Paper says risk off, leverage down, price pressured. Physical says demand present, settlement active, local tightness visible, metal still wanted. That's why the spread matters. The spread is not a trivia question. It is a map of stress. Now let's lay out the evidence with numbers that force clarity. First, the vault ledger. 9,158 tons in London. At the end of January 2026 is the hard inventory figure everyone points to. But the more important question is what portion is free to move, at what cost, and on what timeline. If a significant portion is allocated to long-term holders, pledged as collateral, or held by entities that do not respond to short-term price action, then the immediately mobilizable portion can be much smaller than the headline suggests. Physical tightness shows up when the marginal bar, the bar that would satisfy new demand right now, requires a higher price or better terms to appear. Second, the positioning unwind. 6,000 is leverage leaving. When leverage leaves, it can push the futures price quickly. That can create the illusion that demand is collapsing, even if demand for physical metal is steady or even rising. Futures markets transmit pressure at the speed of execution. Physical markets transmit pressure at the speed of settlement and movement. Third, the delivery flow. A month-to-date figure like 33,783 deliveries in early February is a reminder that the delivery mechanism is not theoretical. The moment more participants choose to convert paper claims into warehouse settlement, the system's capacity and inventory composition matter. In calm times, delivery is a side note. In stressed times, delivery is the plot, because it forces the abstract claim to meet the real-world constraint. Fourth, the Shanghai benchmark extreme. 180 RMB per gram is not just a high print. It is a sign that local demand and local settlement realities are pressing against supply, or at least pressing against the readily available supply at that moment. It reflects a market where the marginal buyer is asking for metal, not exposure, and where the timing of settlement matters. Now the dislocation becomes obvious when you understand the mechanism that creates it, because once you see the mechanism, the contradiction stops being confusing. Picture a highway system. Paper markets are like digital traffic signals that can reroute cars instantly, because the cars are positions. Physical markets are like actual trucks carrying actual cargo. You can change a signal in milliseconds. You can't move a truck across a continent in milliseconds. When a storm hits, the digital system may show traffic flowing somewhere else while the trucks are stuck at a border crossing. The data looks contradictory until you realize you're looking at two different speeds, two different constraints, and two different kinds of truth. In gold, the storm is often a change in funding conditions, volatility, or risk appetite. When volatility rises, margin requirements can tighten. That forces leveraged players to post more collateral or reduce positions. If they reduce positions, they sell futures. Selling futures pushes the paper price down quickly. A lower paper price can trigger more systematic selling, because many strategies are rules-based and respond to volatility and trend. Meanwhile, physical buyers, especially those that operate with longer horizons, can keep bidding for metal or even increase activity, because their objective is not to optimize next week's Mark II market, but to secure availability and diversification over time. There is also a subtle point that matters during dislocations: netting. Paper markets are built to net exposures. 1,000 contracts can be bought and sold and netted down to a smaller open interest, with huge turnover and limited physical consequence. Physical cannot be netted in the same way. A bar must be allocated to someone, somewhere. When paper selling hits, it can reduce prices without immediately releasing metal. When physical demand hits, it can tighten terms without immediately changing the headline spot print. That is how the two stories can diverge, and why the spread becomes the most honest narrator in the room. This is also why experts sound like they are contradicting each other, even when they are looking at the same market. One analyst points to the falling futures price and the positioning unwind and says demand is fading. Another points to physical benchmarks, delivery activity, and local premiums, and says tightness is building. Both can be describing reality, because one is describing leverage and the other is describing settlement. The contradiction is not in the market. It is in the assumption that one layer must always dominate the other. Now, forward analysis, without pretending anyone can predict the future with certainty. Historically, dislocations like this resolve through one of three channels: price, terms, or flow. In a conservative resolution, paper selling exhausts itself, positioning stabilizes, and the spread narrows quietly. Physical premiums ease, futures realign with physical reference points, and the story becomes boring again. When that happens, many people claim nothing unusual occurred, because the headline price did not dramatize the plumbing. But the plumbing will have told its truth. In a moderate resolution, physical tightness persists, while paper positioning remains unstable. In that case, the market often adjusts through terms before it adjusts through headline price. You see it in forward points and borrowing costs. You see it in the ease or difficulty of sourcing particular bar sizes. You see it in increased attention to exchange for physical activity and in subtle changes in how liquidity providers. Quote, "The chart might look calm while the settlement world gets noisy. In a more aggressive resolution, if physical demand keeps pressing and paper flows remain stressed, the dislocation can force a sharper repricing of immediacy. Historically, that can mean wider spreads between venues, more dramatic premiums in physical hubs, and sudden moves that catch people off guard because they were watching only one layer of the system. Not because the market becomes irrational, but because it finally has to reconcile two prices that were pretending to be one. So what should be watched, not as a recommendation, but as a way to read the market's truth? Watch whether positioning continues to compress or begins to rebuild. Watch whether delivery activity remains elevated or accelerates. Watch physical benchmarks in key hubs for persistent premiums or repeated extremes. Watch the vault data, not only for big totals, but for directional changes that suggest metal is being mobilized or quietly absorbed. And watch the conversation itself, because the moment most people start talking about shortages is usually after the plumbing has been signaling stress for longer than anyone wants to admit. Here's where it gets interesting, because the spread is not only a number between two prices. It is a collection of frictions. One friction is form. A large wholesale bar that clears easily in London is not automatically the bar that clears most efficiently in every other hub. Converting bar size and specification can require refiner, time, and trust in assay. Another friction is location. Metal in one vault does not help a buyer who needs settlement in another jurisdiction this week. Moving metal means booking secure transport, insurance, and sometimes navigating regulatory steps that add time and uncertainty. Another friction is timing. A futures contract settles on exchange rules. Physical deals settle on delivery windows, credit terms, and operational capacity. And another friction is confidence. In stressed periods, counterparties become picky. They care about bar lists, brands, and whether a chain of custody is clean. This is why the paper price can trade as if supply is endless while the physical world feels tight. Paper can be created and netted at the speed of matching engines. Physical must be sourced, checked, allocated, and moved. When the paper side sees forced selling, it can shove the headline price down quickly. When the physical side sees persistent bidding, it can keep premiums firm even if the headline is soft. The spread is the truce line between those realities. So if you want a simple mental model, think of the futures price as the temperature of leverage. And think of physical benchmarks and settlement terms as the temperature of availability. When those temperatures diverge, the market is telling you something important long before the crowd notices. Also notice the timing. London Vault totals update on a schedule. CFTC positioning updates on a schedule. Physical benchmarks update daily. Delivery tallies update as notices hit. When those scheduled signals line up in the same 2-week window, it's rarely random. It means multiple layers of the system are reacting at once. Risk desks trimming, physical buyers staying active, and the settlement seam being tested. That is why watching only a chart can be misleading. The chart is the final output, not the first signal. The plumbing speaks first, price speaks later. Spreads speak in between, and that is where the signal lives today. Now we get to the divide. There are always two groups in markets like this. The first group watches the headline price and assumes it is the full story. If price dips, they assume demand vanished. If price rises, they assume scarcity appeared overnight. The second group watches the relationship between paper and physical because that relationship often moves before the headline price tells the truth. They watch the spread because the spread is the market's confession. This isn't about being smarter. It's about paying attention to the right layer. The information gap becomes a wealth gap because institutions move on structure while the public moves on headlines. Institutions see the terms. They see where settlement is tightening. They see which form of metal is being bid and where. And they move early, not because they are clairvoyant, but because they read the plumbing. If you only remember one thing, remember the numbers, because they anchor the story in reality. $467 trillion, 180 RMB per gram on January 29th, 6,000 by February 690. Those numbers are not rumors. They are the market revealing its structure in plain sight. This is channel name, where we decode what matters before its headlines. If this connected dots you hadn't seen, you know what to do. The question isn't whether spreads eventually resolve. The question is whether you noticed the signal before the crowd noticed the price.